After turning bullish gold in December, Wells Fargo is now cautioning investors not to get too excited about the metal. Joining me today to break this all down is John LaForge, head of real asset strategy over at Wells Fargo. John, welcome back. Thanks for joining us on the line here.
Thanks, Daniela. Appreciate it.
So, I was excited to have you on because I read your research note last week and frankly was a bit surprised about you now cautioning investors not to get too excited about buying gold. And I'll read what you wrote. You said at $12.85 and fairly valued versus both stocks and bonds, we believe gold is no great bargain. Why the change of heart, John?
Yeah, gold has recently really not acted as you'd expect with all the increased volatility out there. So stocks in the last few weeks have been hit, and you see the days where stocks really get hit. And what does gold do? Gold is up $3. It's up $5. It's up $7. I think where we are in this bull super cycle, this long cycle with commodity prices, is we're kind of in the dull period. And during that dull period, there isn't much that gets these things going. So you get stuck in trading ranges. And gold right now really is not reacting to things you normally would expect it to react to positively. So at this point, without that kind of, good news is good news, right now it's kind of good news is bad news and bad news is bad news.
And we saw that with the GDP, right, John?
Yeah. It's one of these periods where it just doesn't pay. You're better off in other risk assets. And if you want to get defensive, you're almost better off in other defensive assets too. So the dollar versus, say, gold, if you see volatility. Yeah, gold's just not acting that well, frankly.
Do you think a part of the problem or part of this equation is the fact that the cryptos have been rallying and are now back in focus as the attention also shifted back to there?
I've never put much clout in it yet. It's hard to tell because the crypto stuff is new. And so there's not much data to go on to look at that connection, that correlation. But you would have expected with all the volatility out of the Chinese currency and all the fear around, oh, no, they're going to want to get their money out somehow, you still would have expected gold to rise. So I would expect the crypto to rise, but also gold to rise. So I don't put much credence behind it yet. I'd still like to see more years of data to see the connection between the two. But I would have expected gold to rally under the expectation that, maybe the average Chinese can't get their money out of China.
And that's a valid point, John. Now, when we spoke in December, your price forecast was $1,300 for 2019. Has it changed since then? What kind of target range are you looking at?
It hasn't. Yeah. So basically for this year, I'd expect gold to bounce between $1,250 and $1,350, and that's pretty much what's happened. I'd say now, though, I think your bias is probably to the downside. I'm not changing the target. So I saw the 1,300 target, but I'd say if there's a bias, it is to the downside because gold there's just no interest left in it. It
just comes down to that. We need interest back into the space. Shifting gears here, John, since the start of 2019, 10-year bond yields have continued to fall, but equities are still hitting all-time highs. So what do you make of this inverse correlation between bond yields and risk assets? Isn't this a mixed signal as well?
Yeah, it is. We've gotten plenty of mixed signals in the last few years, though. I think everything got confusing right about the beginning of Q4 of last year. And that's when, Powell said a few things from the Fed's perspective that they were on autopilot. That spooked a lot of people. Then you had commodity prices generally got whacked. You look at oil, lost 40% and so on. But that wasn't necessarily a signal that global growth was grinding to a halt. You'd expect oil to fall 40%, it to be signaling something pretty dire, and it wasn't. So this whole bond yield stock type connection recently, I think, is a mixed signal too. At the end of the day, we think global growth is good, probably a little slower than everyone thinks, but it's not bad. And it doesn't seem to be a signal to us at this point that things are falling apart from an economic perspective.
And we are, in all fairness, we are speaking ahead of the Fed minutes, but do you expect anything crazy to come out of it that could really change the route here?
Nope, not at all. I've talked to our fixed income guys in the last couple of days, and it's pretty much talk about autopilot. Now they really don't want to really say anything to rock the boat. So no, we're not expecting anything surprising to come out.
And aside from gold, John, is there anything that's shining bright for you in the precious metals space?
Not right now. I would tell you the one that I don't like is palladium. Technically, it seems to be breaking down a little bit. Platinum is the better bargain out of all of them that are out there. So silver, gold, platinum, palladium. So the one to fear at this point technically would be palladium, and the one to probably own would be platinum.
So palladium really, in your opinion, just was having a moment a few months ago?
Yeah, it had a moment, all right. It actually had the moment lasted a few years. So if you look at that relative bet between platinum and palladium, they usually trade at a certain type of parity. Palladium really took off because it was being used more. But now we're starting to supply the world with more, and that disparity is going to start. You basically have that close once again. So it's kind of a short palladium, long platinum type trade.
Well, I was getting worried when my neighbor asked me about palladium.
Yeah, exactly.
John LaForge over at Wells Fargo, thank you so much for joining us today. Thanks for joining us on the line.
You're welcome anytime.
We'll speak soon, and thank you for watching. We'll be back tomorrow.